Hello and welcome to this edition of the video market updates from Orbex.com. Another week has passed and the US dollar index continued to decline and broke through key support areas, which also deepened the bearish outlook. This is after a week with few economic releases also from the States. But the main reason behind last week's decline is that some of the Republican senators in the state has announced that they will not back the new version of the Trump scare, which also fueled the market estimates that Trump's economic plan is not on the right track and unlikely to be implemented if in full. As a result, the U.S. equities also declined sharply, but at the same time, where such decline was only for a short period of time before recovering again, while the U.S. dollar index closed below the 95 barrier for the first time since June of last year. The index also closed the week on the weekly lows, or closed at the weekly lows, which also keeps the bearish outlook unchanged for the time being. But while any upside retracement is likely to remain limited below the same 95 barrier. Another interesting event last week was the ECB decision, which came in also as expected. The ECB left the current policy unchanged as widely expected, but at the same time, it was uncertain about the timing of the next round or when to taper the QE even further. Yet, the market seems to be still convinced that the ECB might taper once again in September of this year, despite the fact that the ECB also noted that such decision is hard to be taken right now, but it might be in September or even beyond that. The euro, as a result, spiked all the way up to 1.1680s and nearing the 17 or 1.17 barrier, which also is the highest level since August of 2015, which should be watched very carefully ahead of the busy week ahead. But at the same time, a break above that resistance would turn the bullish outlook to strongly bullish again. Of course, we will talk about the certain levels or some levels later in this video. Going to oil prices, and despite the fact that OPEC and non-OPEC members decided to extend the current deal until March of next year, OPEC production is still rising. So far, the production has increased for the second month in a row, while on Friday, reports showed that the production is likely to rise even in July, which means that this would be the third monthly increase in a row, one we have not seen since 2015. These reports also managed to put another round of pressure on both Brent and West Texas, while they were also trying to break key resistances last week, such as the Brent as around like $50 and the $47 or $47.50 for West Texas. This is also despite the fact that we had a notable decline in the U.S. crude oil inventories for the past weeks, which basically declined for the third week in a row. This week, traders also need to keep an eye on the OPEC meeting, as there is still a possibility for deeper cuts in production, according to many reports, which might also lead to some rally in crude oil. This is only if they decided to do so. As for the week ahead, there are also only a few economic figures will be released this week, but trading volume is likely to remain on the rise due to the significant economic figures that we will be waiting this week. But beginning on Monday, it's all about the manufacturing of the services PMI from many of the Euro area countries, including Germany, France, and also the EU. In the US, also will be watching manufacturing and services PMIs in addition to the existing home sales. On Tuesday, nothing much is expected in Asia except the Bank of Japan monetary policy meeting minutes will be released, while in Europe, all eyes will be on the German IFO business climate. As for the US, during the same day, we'll be watching the Ecb Consumer Confidence Index and Richmond Fed Manufacturing Index. On Wednesday, it is all about also. It's going to be a very busy during the it's likely to be very busy during the Asian session as we wait for the inflation data from Australia and the Reserve Bank of Australia governor will be also speaking on during that session. During the European session, also we'll be waiting for the UK GDP, which is set to grow by 0.3% in Q2 of this year, after growing by only 0.2%, which needs to be watched very carefully, as any reading below the 0.3%, this would increase the chances for another round of QE, or maybe we don't know what the Bank of England is going to do after that. During the US session, also we'll be watching some data from the States, especially the new home sales. We'll be having also the crude oil inventories in the States, and most importantly, eyes will be on the FOMC decision, which is set to be or to remain unchanged during this decision. On Thursday, nothing much in Asia and Europe, while we'll be watching only the US durable goods data and also the initial jobless claims on Thursday. Finally, on Friday in Asia, we will be waiting for a bunch of inflation data in Japan, in addition to the jobs report and retail sales. In Europe, we'll be watching also some inflation figures from Spain, France, and Germany, while the key data or the key event will be from the States, as we will be waiting for the GDP or the advanced GDP in the US, which is set to grow by 2.5% in the second quarter of this year. This is it for the fundamental part of this video. And now let's have a look again at our technical charts and update the levels for the week ahead. Beginning with the US dollar index as always, and we can definitely see what happened actually last week. And the chart is not looking so great. First of all, we broke below the 95 on the daily chart, and also we're on the daily or whether on the weekly chart, but we broke below the 95 for the first time since almost September to August of 2015, 2016. This is the first weekly close below the 95 since August of last year. But such break basically opens the way for further decline, and especially that also even like we broke through the 94 and we closed at 93.85. For the time being, the 93.88 might be a little bit supportive, but the most important level that we need to keep an eye on over the next few days and the next few weeks is the 92.80s, which basically presents a very solid support that held since 2015. Whether in May or whether even 2015 or even in June of 2015, it was a very solid support area. For the time being, also looking at the technical charts, there's still a possibility for a little bit of more room for to the downside, but at the same time, technical indicators are almost like heavily oversold, which means that it must be some sort of like a retracement to the upside. But at the same time, any retracement for the time being is likely to remain for the time being limited below the 95 or even the 96. I would say at most the 96 before the downside trend continues. But at the end, the general outlook remains bearish in most time frames, whether on the daily, on the weekly, or even on the monthly. The monthly, I mean, the monthly looks very interesting even for the past few few months. We had like 1, 2, 3, 4, 5 consecutive or 5 months of consecutive declines. We've never seen this like until back in 2011, which is, again, it might be like a yearly trend, which might even continue. But for the time being, the next level to keep an eye on is 92.87. Going forward also into to our like next charts, and starting with our interesting pairs, including the Kiwi and the Aussie. So we finally broke above the resistance area, we can say, especially that the Kiwi now is trading above the 200-week moving average for the first time since 2014, which is something very important to keep an eye on. Despite the fact that technical indicators on the weekly, on the monthly, or even on the daily, they are all heavily overbought on most time frames. So despite the breakout that we've seen for the past few weeks, or like especially last week, I still believe that we might see some sort of interventions by the central banks, whether the Reserve Bank of Australia or the Reserve Bank of New Zealand. But the last level that we need to keep an eye on, if we are still interested to short, which is in 75, for a retracement only, because right now after this breakout, it looks like we're going to see like some sort of a retracement and then all the way back up. The retracement is likely to be also limited within the same area, which is 72.55. The Aussie has the same scenario, but the Aussie is still lagging a little bit. However, we broke above the resistance that we saw in February of 2016. Now is at the highest level since 2015 March. The first level to keep an eye on, which is at the 80.26, so it's 80.26 also, to psychological resistance here, and 80 for you would be the 2015 highs or 2015 resistance area. That will be the next level to keep an eye on. But at the same time, again, like weekly, monthly, daily, most of the technical indicators are heavily overbought, which means that we need to see some sort of a retracement. But for the time being, the retracement is likely to be also limited above the 77 areas. Going back also to the euro. The euro continues to rise also. Right now we broke above like certain levels, certain key levels, including the 15 psychological resistance. For the next few days, we need to keep an eye on the 17 and the 17.16, which might be seen maybe on Monday or even Tuesday. But a break above this area, that will be very huge and very significant for the euro, because this would be the first break above the 1716 since almost 2014, which basically would upgrade the euro status to strongly bullish, which possibly might even continue all the way to 120. We don't know, but that's still a possibility as well. British pound, it was a little bit weak last week due to many factors, whether the Bank of England, some economic data also were a little bit wasn't really good. At the same time, we still have the Brexit negotiations, which also continued, but without any kind of like very good negotiations or without any kind of deal so far. But there's still some sort of negotiations going back and forth with no deal. So I guess this would increase the tensions in the market in the next few days. But this week we'll be waiting for the GDP. For the time being, the failure to stabilize above the 130, that would give us a little bit of a hint, might continue all the way back to 2920s, like just at least for a retracement before any kind of upside resistance. But for the time being, 130 represents a very solid resistance for this week. As for the Japanese yen, it continues all the way back down, right from the resistance area that we said that we're going to keep an eye on, especially that we haven't closed last week above that resistance. It continues all the way back down. Now we're below the entire moving averages. This would be, or the upside that we saw above the 1430, that was a little bit of a trap, but it continues all the way down. We have a bearish engulfing candle on most of the trading time frames, whether the weekly or the monthly. But the weekly looks very interesting. Also on the monthly, continues to define with a bearish shooting star on the monthly chart. This would continue to support our idea for another decline ahead, possibly toward another low, maybe around 110.70. That would be the next level to keep an eye on. 110.70 followed by 109 and about 110, let's say. Finally, gold and silver. Gold and silver actually proved themselves both for the past few days, or for the past few weeks. Also, despite the fact that gold has already like broke the rule of the higher lows, but still we rebound right from a very significant area, which is the 12.10, 12.14, breaking above the entire moving averages. It would continue and keep the possibility for another rally ahead. However, if you look at the 61.8% retracement, this is what I would like to see. I would like to see a break above the 1262 to make sure that gold will have like another push all the way back to confirm the $1,300 mark to reach or to retest it once again. But for the time being, there's still very significant break above. So we still believe there might be some sort of retracement next week above like 1240 before any upside resistance. Silver continues to rise, but still I need silver to rise above the entire moving averages first in order to prove itself. But last week we had a very good stabilization above the 16. Now we will be looking for the 50-day moving average, which is 1669 or 1670. Above that resistance, we'll be looking for another also bull run towards 1690, and I would like again to see a break above the 1750 or 1740 in order for silver to prove itself that it still has some more potential during this year. Thank you for watching this week's video. Please like, share, and subscribe to Orbex channel on YouTube to get the latest. If you have also any questions, please leave them below this video on YouTube, and I'll try to get to answer your question as soon as possible. I'll see you once again next week. Have a great week ahead.